to offer. It's a new year, but there is no new rules of the game when it comes to planning your finances and investments. But the new year brings in some introspection and some resolutions. So let's take a note of lessons learned last year and plan for better future. Let's begin with getting an overview on your financial investment with a very special guest on the show today, Rajiv Bajaj, Vice Chairman and Managing Director at Bajaj Capital. Thank you so much, Mr. Bajaj, for joining us. A very happy new year to you.
You too.
So new year brings in resolutions. And what is the financial resolution that you'd like to advise the viewers?
Right. So first of all, a very happy new year to all the investors and all your viewers. For me, every day is a new year and a new resolution. And I come from that school of thought in investments that you need to have a good investment strategy in place. You need to have proper asset allocation. You need to be aware what is your long-term goal and what kind of risk can you handle. So it's a year-round thought process, but all the same, beginning of the year is the time when you reboot your mind and your portfolio, and a time to take a fresh look and decide you know whether whatever you've been doing so far is right and what changes could one make.
You know, I started with saying, like, let's think of things we've seen in the past or the lessons we've learned. 2015, if one was to see that, the most heartening thing we saw was the inflows of retail investors when it comes to using mutual fund as a route for investment. And we consistently saw that despite the volatility that 2015 witnessed. And we've been time and again talking about that, how a long-term investment helps you beat volatility and so on and so forth. But going in 2016, do you think the investors are going to be slightly nervous, or do you think that this trend is going to continue and we are finally seeing some change in mindset in terms of investors realizing that long-term investment is the way to go?
Right. So, if one sees the trends, May 2014 onwards, ever since we've had the new regime, the investor sentiment has turned positive. I've always believed this and, shared it with friends and investors, that investors always have money. Whether they are willing to part with it or not is a matter of thought. So, people were holding on to their money for the last 4-5 years. Since May 2014, people have begun to invest, because the overall investor sentiment has improved. So the overall confidence level in the economic, they may not have full confidence in the current economy, but they have confidence in the way the economy is being shaped. And hence, if you see the mutual fund flows, month on month, for the last 18 months, they've been positive.
But if you look at it now, do you think that there'll be certain nervousness setting in that, 1 year or 1.5 years now we're seeing certain level of volatility, those attractive returns that probably we would have seen from the dips to now is not really coming in? And what would you like to advise to them?
Right. So, yes, what has happened in 18 months, people are curious to know whether it will continue in future. But just going back for a minute to the last 18 months, some very noteworthy trends that the sales have not happened only in the pure equity funds. It has also happened in these, what are these called, the balanced advantage funds.
Correct.
The balanced funds as a category has re-emerged. And I have myself been very curious and thinking hard about it and doing research on it and spoken to several investors that why are they investing in balanced funds. And my conclusions are very interesting. I think finally, people are beginning to develop a relationship of comfort with risk.
Okay.
Risk is a bad word. Anything in life, like we cross the road, there is a risk of getting hit by something. So we, in the world of investments, risk is the dirty word. Whenever you sit with a financial advisor, they always talk about returns. कि बैंक में आपको 9% मिल रहा है, आप FD में लगाइए 11 मिलेगा, equity में 15 मिल सकता है. Those are the conversations. People always talk about returns, but they never talk about risk. And I believe that 2015 has been a watershed year where people have begun to understand risk. And they have decided to start investing accordingly. So a bulk of the equity fund sales, they have been in these balanced funds. And a lot of skeptics may say it's because of the tax situation, because debt funds, due to the 3-year taxation, people are now coming in equity arbitrage funds. But I would look at it positively and say that because the track record, if you see the 6 months, 12 months track record, even in the quarters in last year when the index was giving negative return, these funds have given positive return. So with this foundation, we are entering 2016. So people will continue to be investing on a risk-adjusted basis. I think this trend, which has formed, it will gain in momentum until there is a definitive bull run, till there is a corporate turnaround, you know, in performance and all the reforms which the government is doing before they start showing the results, which may be 2016 and 2017. None of us can predict sitting here now. People will continue to invest in a cautious manner. And that's my view.
What do you think on both the regulatory side and the government side that they need to do in terms of pushing or encouraging the investments with regard to the equity investments particularly, and bringing in more retail investments in the equity markets?
Right. So first of all, I must, commend all the stakeholders. I must, compliment the regulators, because I do, circles go around in ministry and SEBI and, these other regulators' offices. There has been a vast change in the mindset. So the proactiveness, it's almost like a private sector atmosphere. They are proactively calling you. If you're writing a suggestion, you're getting a response back within 24 hours. So there is this desire to grow the market. So I have already seen that change. So, from that era of protectionism, regulation used to be about protection of investor. Now it is also become about education of investor and development.
Opportunity.
And development of the markets.
Correct.
Because what the flows of equities we've seen last year, that is just a tip of the iceberg. We are still only 2 to 3% of Indians are invested in capital markets, which is nothing. So we could easily be at 10%. We don't need FII flows in this country. 30,000 crores has come in last year in mutual fund SIPs, which is sustainable long-term investment for the government.
Correct.
This can easily become 1 lakh crores. So the regulators, what they need to do now is simplify the operations. I think the KYC norms and we are talking about technology, digitalization, reducing the cost of transaction, but a lot of work has to be done. Where it almost costs 150 rupees to do KYC of one investor. So, it is not fair for the poor investor or the financial advisor, because it is, if you are building in these high costs of paperwork, then ultimately, the fees will have to be high, and ultimately it's going from investors' pocket only. So my simple question is that somebody sitting somewhere has to think of it, that if a bank KYC is being done, the same bank money is being routed, in mutual funds or in insurance. So why do you need to do a separate KYC?
One.
So, single KYC, and then, providing technology platforms. I think this is one work. And then also at the industry level, the role of financial advisors, we believe that we are somewhere deep inside, our community is low on self-esteem, because we get a lot of brickbats for cases of mis-selling, which I'm not denying. There are cases of mis-selling. But we have seen surveys that 85 to 90% of investors, like DSP BlackRock Mutual Fund did a survey, 90% of investors are very happy with their advisors. So for 10% people, black sheep, why are you not recognizing the people who are doing a good job? If this this huge flow that has come into equity markets, this 30,000 crores in SIPs, so somebody somewhere, there has been a good relationship and connection between an advisor. So I believe an SRO of financial advisors and allowing them to improving the professional standards. I think this is what will help us more than investor education, which should continue.
Well, time for a quick break, but on the other side, let's focus on how you can axe the tax in 2016. Don't go anywhere. Email and register your queries at smartmoney@btvin.com. Let me put my focus into another area of financial planning, and which is insurance. We've seen a lot change in the insurance side, and you talked about mis-selling. That was one industry that had to battle the mis-selling of the ULIPs quite, in a bad light, really.
Yeah.
things have changed? How do you see insurance panning out? It still remains because, for the tax push that it gets, it still remains that one is joining a profession and is looking at an insurance policy. But are we moving towards getting ourselves adequately insured? How are ULIPs right now, the transparency that they offer? And of course, if you look at even, the term plans that most of the advisors, say is something that you should begin your insurance with, are becoming very competitive. So how do you see that landscape changing?
Right. So, very, very important question. And let us start with the term plans. Let's see the role that has been played by these comparison sites. Worldwide, there have been insurance comparison sites, and India has them, a few of them now. And it is just a click away. You get onto your computer screen, and you whether it's a medical insurance or it's a term insurance, you just enter how much, what is the benefit outcome you're looking at, and you get the lowest premium and the best possible features suggested to you.
Correct.
So, this change has already happened, and all the, you can say, old world organizations internally are also changing their systems to be more consumer friendly. So that is one. ULIPs. What a revolution and all credit to IRD and all the industry players to make it happen. There's been a complete revolution in ULIPs. The current generation ULIPs, if you are an investor with a more than 10-12 year horizon, ULIP in terms of costing is as competitive as a mutual fund.
As a mutual fund.
So you're getting an insurance cover and at a competitive price, and with a fund manager who does not have the challenges of an equity mutual fund manager. Because an equity mutual fund manager always has to keep some money in cash because it's an open-ended fund, whereas the ULIP fund manager knows that the money is available to him for longer term. And hence he can take more calculated decisions on longer term investments. So ULIP has emerged as a very good alternative. I think the kind of money flow we are seeing in ULIPs is not fair to the robust structure of the product. Coming to traditional plans, that's a niche market, and I do not see it going down, but I see it growing at a declining rate.
We discussed last time we had the conversation, which was, the last budget, and we were discussing on the way the NPS has been given a push. Do you think that till the time that we see that EET turning to EEE, NPS push will remain, muted till such time?
Right. So, NPS, I think it is one of the most under-leveraged, financial inclusion tool, which the government has, and the recognition of it as the flagship tool to bring in the first-time investor. So, if you want to bring in a 25-year-old IT worker in Bangalore into capital markets for the first time, I would say NPS would be the most Puritan form, because it is low cost, it is long term, there is a proper structure, there is also auto rebalancing. It's a kind of a life stage investing product.
Correct.
So it is almost like a fill it, shut it, forget it kind of an investment. So because the distribution has not been properly thought through, or at least it has been thought through, but it is not the machinery is not oiled, people are not getting adequately remunerated to go and talk about NPS to investors. So, and the information available on NPS on websites, the comparison of different pension fund managers is not available. And hence, NPS, but given these tax advantages that has been given, that exclusive 50,000 rupees tax benefit which has been given in the last budget, despite EE not being there, the volumes are already beginning to go up. And there are already 1 crore people who have invested in NPS. So to get get top-ups from them, if they are better informed in terms of how their fund is performing, they will come up with top-up investments. So those 1 crore people referring it to others and putting in their own top-ups, I think that is the first opportunity which needs to be looked at. So and I would on this show request the government that why shouldn't it have parity with equity mutual funds? And it should be EE in all fairness.
All right, but last but not the least, if you were to predict the certain investment trends that you think would emerge and dominate 2016, what would it be?
Right. So I put a disclaimer first that I'm not a crystal ball gazer, and none of us are. And I believe what I said at the beginning, that the biggest learning for me or the trend search for me has been that people have now understood, they have begun to understood the benefits of risk-adjusted investing. I think I would want the investors in 2016 to consciously develop a relationship of comfort with risk. The fact that if you are getting into, so for example, if your equity portion in portion of your portfolio is 30% right now, and if you're taking it up to 60, so being conscious of how much risk you're increasing, what could be the volatility you could be bringing in your portfolio, what kind of investment options you should be choosing. I think that's the right way to go. 2016 specifically, I personally believe markets never, call you up and before running up. So even the 2014 run just happened out of the blue. Most of the people missed out on the opportunity. The next run, the next 10-15% run of the market, it will happen anytime. At the, it could be 2016, early 2017, that we can't say. But we as investors have to be in the market. Correct. So we can just keep tinkering with our allocation. We could be underweighted, overweighted. We as a house right now, we are neutral weighted. So for example, if your portfolio should be 30% equity as per your financial advisor, keep it at 30% and keep rebalancing. So do not be out of market. Be there to catch that opportunity. It could happen anytime.
Anytime. All right. With that, thank you so much, sir, for joining us and taking time out. Well, time for a quick break, but on the other side, let's focus on how you can axe the tax in 2016. Don't go anywhere. Email and register your queries at smartmoney@btvn.com.